So we know that a lot of people have just gotten a $1,200 stimulus check from the US government, and it may be burning a hole in your pocket, meaning you are just out there looking to spend it. But before you go out there and spend your stimulus check on a Gucci belt or something like that, we're going to cover the money traps or money mistakes that you want to avoid in a recession. And for those who are not familiar, a recession is simply a period of time where there is a decline in overall economic activity. So people are spending less money, employers are not looking to bring on new employees, or you are seeing a lot of layoffs. And in a nutshell, it is basically a time of uncertainty, and you want to make sure that you are prepared financially, or at the very least, not setting yourself up here for failure. Now, whether or not we are currently in a recession is debatable, but if we are in fact entering a recession, these are a few of the mistakes that you may want to avoid. Alright, so first of all, number one here, as we mentioned earlier on, the biggest mistake that you have to avoid right now is wasting your stimulus check if you did in fact receive one. And it's important to remember what the purpose of these checks actually were, and it was essentially a way to get people money who were in a dire situation, and that money is meant to be used towards things like your mortgage or your rent payments or groceries or things like that. And this is a pretty shocking statistic here, but according to Go Banking Rates, they conducted a study that found that 69% of Americans have less than $1,000 in savings. So for the majority of people who received this stimulus check, this is the largest amount of money they have ever really had in their savings, and they may be tempted to go out there and spend it. But I encourage you to keep in mind what the purpose of this check actually was, and only use it for emergency type spending. Now personally, I would place this stimulus check money in a completely separate online savings account. That way you're not tempted to spend it, you don't even see that it's there, and you may even forget about it and remember it on a rainy day when you actually need the money. If you leave it sitting there in checking, every time you log on to your bank account, you're going to see that money, and if you're like most people, you're going to be tempted to spend it. Now, rates for savings accounts are extremely low right now based on the Federal Reserve lowering interest rates, but Betterment does have a great online savings account that does pay probably one of the best rates you are going to see out there right now based on the low deposit required. So if you guys want to check that out, you can open up a Betterment Cash Reserve savings account with just 10 bucks. I'll link up to that down in the description below. And this is a great high yield online savings account and a good place to tuck your stimulus check away where you won't be tempted to spend it. Now, if you do use that link, guys, I am affiliated with Betterment, so I may earn a small commission in the process. Alright, so the second big mistake you want to avoid in a recession is taking on more debt. And it's very tempting right now because pretty much all of these retailers and car salesmen and things like that have really good incentives, or what appear to be good incentives right now, to get you behind the wheel of a new car or to get you to refurnish your entire home, because they are struggling right now based on us potentially being in a recession. One of the first things people do is stop spending money on their non-necessities, such as furniture or cars or boats and things like that. So as a result, there are some pretty wild incentives being thrown around right now. For example, Ford is currently offering no payments for up to 6 months if you purchase a new vehicle. And while that may sound tempting, this is not the time to go out there and buy a new car and take on a larger monthly payment. And I know that a lot of people are currently on unemployment, and based on the additional money being kicked in, I've heard from a lot of people that they are currently making more money unemployed than they were ever making while they were employed. And while that is great, you do have to remember this is a very temporary situation, and you can't inflate your lifestyle based on 6 months of increased earnings. So avoid taking on more debt at all costs. Don't go out there and buy a new car. And as tempting as it may seem to take advantage of some of these financing offers, this is just not the time where you want to be increasing your monthly payments based on the level of uncertainty. So the third money mistake you want to avoid in a recession is something called lump sum investing. And that is essentially when you take a large sum of money and you put it into the market all at once, rather than putting your money into the market over a longer period of time. And so the problem with lump sum investing, really at any point in time, is that when you do this, you no longer have this opportunity to average down if the stock or that fund begins to trade lower. And at a time like this, when the markets are moving up one day and down the next, this is not a time where you want to just randomly dump all of your money into the market at one point in time. And I'm going to show you guys an example of why you wouldn't want to do this. So let's say you wanted to buy some airline stocks based on the sell-off that began back in February. Well, from February to March, shares of American Airlines stock fell around 50%, from $30 per share down to $15. And a lot of people looking at stocks said, wow, that looks like one heck of a deal. So let's say, for example, at $15 per share, you took all of the money that you wanted to invest and dumped it all right into American Airlines stock. Well, even after that happened, the stock continued to fall, and it actually fell to a low of $9.09 per share. And if you dumped all of your money in at $15 per share, well, from $15 down to $9.09, you would have lost 40% of the value of what you had invested. Now, on the other hand, if you were just to invest a small amount of money every single week, rather than lump sum investing, you would be able to average down with that position and essentially lower your cost basis. So you'd buy a couple shares at 15, a couple shares at 13, a couple shares at 10, maybe you grabbed a few at 9, and as a result, you are lowering the average price that you've paid for these shares. So if you are investing at a time like this, which is generally a good idea, avoid dumping all of your money into the market at once and instead follow the strategy here of dollar cost averaging. Also guys, if you are enjoying the video so far, all that I ask is that you go ahead and drop a like for the YouTube algorithm. It helps out and allows this video to be shared with more people. So moving on now, number 4, the fourth mistake people make in a recession is pulling out of the market and essentially moving into cash. And this has been happening over the last couple of weeks. That is why the markets are down 20 or 30% right now. And that is because more people are selling than there are buying, which increases the supply of shares going to the market and lowers the price because of less demand. So a lot of people during times of uncertainty want to be in cash because it's certain the price doesn't change. But the problem is you are taking a massive loss in most cases by selling at a time like this. And if there's anything we've seen over the last couple of weeks here, it's that the stock market can change very quickly. We saw what has been so far the shortest bear market in history because just a couple of weeks after it began, stocks rallied over 20%, officially exiting bear market territory. Now, is that going to continue long term? Nobody knows for sure, but if it does and you sold out at the bottom, that was a bad time to sell and you missed out on that 20+% rally that happened immediately after. So unless you're in dire straits where you need to sell your stocks to pay rent or pay your mortgage or pay for your utility bills, this is not a time at all that you would want to sell any stocks or bonds or investments like that are currently down. And lastly here, number 5, the final mistake people often make in a recession is one of the most costly mistakes that you can make long term, and that is skipping your retirement contributions. So a lot of people are looking at their 401k right now, and they're seeing that they are down massively, and based on psychology, they say, hey, you know what, I'm down, I'm frustrated, I've had a paper loss here in terms of my return, I don't want to put any more money into my 401k because I don't want to lose it. And while that does sound right in your head, in terms of the right move financially, that is pretty much the equivalent of shooting yourself in the foot. Because right now, you are able to get shares of companies at a massive discount compared to where they were trading at just a couple of months ago. And most people are pretty much agreeing that this is going to be a very short recession if we do in fact enter one, because it was based on this black swan event that nobody saw coming. So after this is all over, after the world opens up again, we should return to a prosperous, growing economy, and the stock market should reflect that. So for example, if you look at the S&P 500, over the last year, it traded at a high of around $3,400, and at the peak of pessimism over the last couple of months, it dropped to a low of about $2,200. So that means that you were able to buy shares of the 500 largest publicly traded companies in the US collectively at about a 35% discount. And the crazy thing is here is people are willing to buy shares of stocks at all-time highs, but as soon as they go on sale and you're getting a better bang for your buck, people don't want to buy them. But right now, you're getting them at a massive discount compared to where they traded at earlier on this year. Now keep in mind that returns with the stock market are never guaranteed, but over the last 90 years, the average annualized return from the S&P 500 has been 9.8% per year. So over the long term, looking at a large sample of data, the stock market is a great way to grow your money, and when you invest during a time like this, you are getting a substantially better bang for your buck. So this would be one of the worst possible times to stop contributing to a long-term investment like a 401k. But anyways, guys, that's going to wrap up this video. I hope you enjoyed it. If you made it all the way to the end, feel free to share this video with a friend or family member who may enjoy it as well, or somebody who may be out there making some of these financial mistakes themselves. And lastly, if you want to get 2 free stocks, Webull is currently running a promotion where if you open up a brokerage account with them, you're going to get 1 free stock just for signing up. Then, if you fund the account with $100 or more on your initial deposit, you're going to get a second completely free stock. That's going to be the top link down in the description below if you want to grab those 2 free stocks. And Webull is a great commission-free brokerage for beginners looking to invest in the stock market. I am affiliated with Webull, so I may earn a small commission if you decide to use that link. But thanks so much for watching, guys. Subscribe and hit that bell if you haven't already, and I will see you in the next video.